Welcome to the deep dive. Our job is simple. We take that stack of dense corporate reports, pull out the really essential stuff, and, well, deliver it straight to you. Today, we're tackling the latest investor presentation and financial results from Tata Capital Ltd, TCL. This covers the quarter and the half year that ended September 30, 2025, so Q2 FY26. Now, our mission for you on this deep dive is, I think, pretty critical this time. TCL just finished a huge strategic move, buying Tata Motors Finance, or TMFL, so to really get a handle on where this financial giant is heading, you can't just look at the combined numbers. You have to skillfully navigate the figures with and without that newly merged business. That's how you spot the core momentum and, frankly, assess the integration risks.
Yeah, that navigation skill is absolutely key right now for understanding TCL. And just to set the stage a bit, it's really important to grasp the sheer scale and the regulatory position here. TCL is what they call an upper layer NBFC. That's a regulatory label that basically means they're so big and systemically important that they face much stricter oversight, almost like a major bank.
And they only recently listed, didn't they?
That's right. Successfully listed on the NSE and BSE just this past October. And they've got that prized AAA domestic credit rating with a stable outlook, the best you can get. When we talk about scale, we are talking about a massive operation, roughly euro 2.44 trillion, which is around $29 billion in assets under management, AUM, as of September 30th. It's a huge foundation they're building on.
Okay, right. Let's unpack this then. Before we get into the maybe the headache of integration, we really need that baseline. We need to see TCL without the motor finance part. That gives us the pure organic growth picture. And what you see in those organic results is, well, pretty explosive momentum. If you just isolate the core Q2 FY26 figures, that gives the cleanest year-on-year comparison. The growth is really strong. AUM, again excluding motor finance, grew to euro 2,015,574 crore. That's a 22% jump year over year.
Yeah, 22% growth at that kind of scale is definitely competitive. But what's maybe more telling about the underlying health is how that growth flows down to earnings. The profit after tax, the PAT, for the core business, it surged 33% year over year, hit euro 11,028 crore.
Wow, 33% PAT growth. That's huge. Does the net total income back that up?
It does, absolutely. Net total income also grew significantly, 28% year over year, 3,330 crore. So what this tells you is the core business, retail, SME, housing, it's not just growing the loan book, it's doing it efficiently and, it seems, with better margins.
Okay, but the real test for any lender is always asset quality, right? Is that strong growth coming at the cost of maybe weaker credit standards?
Actually, it seems like the opposite. They're getting better at managing risk. The annualized credit cost actually went down to 1.1% in Q2 from 1.4% the quarter before. So they're spending less on covering potential bad loans. And the core asset quality itself, rock solid. Net non-performing assets, NNPA, held steady at a very low 0.6%. That's strong conservative performance.
And how do those metrics combine into the return figures, the ROA, ROE?
Looking pretty healthy there, too. The annualized return on assets, ROA, nudged up slightly to 2.2%. Compared to 2.0% the same time last year, shows they're using their assets effectively. And, maybe more importantly, the annualized return on equity, ROE, with 14.9%. So yeah, these figures really confirm that TCL's core lending is efficient, highly profitable, and critically well managed from a credit risk angle.
Okay, so that strong core engine provides a kind of safety net. But here's where it gets really interesting. Navigating that motor finance integration. The TMFL deal closed back in May 2025. So now we have to look at the consolidated numbers, which show both the massive new scale and the immediate challenge they took on. Right. And when you look at that fully combined picture, the AUM is 2,043,896 crore. That's only about 3% sequential growth quarter on quarter. Kind of reflects that pause during integration, maybe. And the consolidated PT for the quarter, including motor finance, actually dipped slightly to 1,097 crore, so a bit of a drag from the integration onto that very profitable core. TMFL is now about 10% of the company's total gross loans.
And that 10% brought the main headache, the drag on asset quality.
Yeah.
If the core business had that nice 0.6% NNPA, well, the consolidated figure jumps immediately. Their consolidated net stage 3, which is basically the banking term for NNPA, rose to 1.1%.
Right, a jump from 0.6% to 1.1%. What drove that specific increase?
It was primarily the motor finance portfolio they brought in. That portfolio had a gross stage 3 ratio of 7.7% back in September. Now, for you listening, gross stage 3 means loans where payments are seriously overdue. It's essentially the gross bad loan ratio they inherited. And cleaning up a 7.7% bad loan ratio in a chunk that's 10% of your business, that's a big job.
Yeah, 7.7% sounds like a heavy weight. Management must have a pretty aggressive plan to turn that around, especially since it affects the whole company's reported numbers. How are they tackling that?
They seem to be hitting it with a three-pronged strategy. The focus is clearly on stabilizing things before pushing for growth again in that segment. First, they're aggressively changing the mix of loans within that portfolio. Historically, maybe motor finance leaned on heavy commercial vehicles. Now they're pivoting hard towards used vehicles. Used vehicles made up 47% of the Q2 disbursements in motor finance, up from 42% just a few months earlier.
Okay, why the big shift to used vehicles specifically?
Well, used vehicles often have, better collateral stability, maybe lower average loan sizes. This can mean faster turnover and maybe lower overall risk per deal. They're also boosting light commercial vehicles. ILMSCV new disbursements are up to 23% from 16%. It's really about trying to move up the quality curve within that auto segment.
And I noticed they're also moving away from just being the finance arm for Tata Motors.
Yes, exactly. That's the second prong, diversification. They're quickly moving to a multi-OEM model. That means they're financing non-Tata vehicles now, too. That reached 13% of new vehicle disbursements this quarter. Opens up a much wider market, obviously. The third element, and this is maybe the most powerful tool they have, is the advantage from the merger itself.
Tell me more about that. What advantage?
Cost of funds. Because the whole merged entity now carries that AAA rating, the interest rate they pay to borrow money is significantly lower. Management actually pointed to an immediate benefit of about 60 basis points, or 0.6%, reduction in their cost of funds, specifically for the motor finance operations. Now, saving 0.6% on your borrowing costs? That's pure margin gain. It can directly help absorb the costs of cleaning up that 7.7% Stage 3 book. It's a really powerful lever they can pull to fund the turnaround.
That 60 basis point reduction in borrowing costs, that's a huge structural plus. But is the timeline realistic? Management is aiming for the motor finance business to be profitable again by Q4 of FY26. Given that 7.7% starting bad loan ratio, is hitting profitability in just, 2 more quarters? Is that too ambitious?
It's definitely aggressive, no doubt. It signals a lot of internal confidence, but it also reflects the scale of these strategic shifts we just talked about. They aren't just sitting back waiting for old loans to perform better. They seem to be rapidly swapping out the higher-risk book with lower-risk products like used vehicles and funding it all with cheaper money thanks to that 60 BPs saving. Success really hinges entirely on how fast and effectively they make these portfolio changes over the next, say, 6 months.
Okay, so shifting focus back now to the rest of the business, that 90% that's doing so well, let's look under the hood at where the money's actually flowing organically. TCL's business seems structurally sound, mainly because it's so heavily focused on retail and SME customers.
Yeah, that diversification provides really crucial resilience. Retail and SME make up about 88% of their total gross loans. This is fundamentally a business built to serve consumers and small businesses. And even the potentially riskier parts seem managed. Unsecured retail loans are only about 11.6% of the total loan book. That suggests they aren't leaning too heavily on high-risk, high-return stuff.
And breaking down the actual products, it looks pretty balanced too. Top segments are home loans at 17.2%, term loans 17.1%, and loan against property LAP at 12.3%. It's a good spread of mostly secured assets.
And within that mix, we absolutely have to highlight their crown jewel subsidiary, Tata Capital Housing Finance Ltd, TCHFL. TCHFL is acting as a really powerful counterweight to that temporary drag from motor finance. Its AUM grew by an amazing 30% year-over-year, hitting 75,636 crore.
And its asset quality numbers are they're staggering, aren't they?
Oh, they're essentially best in class for the entire sector. TCHFL's net NPA is minuscule, just 0.3%. And the annualized credit cost is incredibly low at 0.1%. This subsidiary isn't just showing scale, it's showing near-perfect operational execution in credit underwriting.
And I appreciate that they're also showing market depth by focusing on affordable housing, not just high-end stuff.
Exactly. That's key. They're not just chasing big-ticket home loans. Their average loan size in the affordable housing segment is just 12 lakh. That shows smart diversification into high-volume, potentially lower-risk segments that also happens to align well with, social impact goals.
And all this great performance seems to be underpinned by their distribution model. They call it phygital, a mix of physical and digital.
Right. The physical growth is really rapid. 1,479 branches across 27 states now. That's 2.7 times growth since March 2023. So they're planting flags quickly all over India. But that physical network is backed by massive digital reach. They quantify it with over 140 lakh. That's 14 million plus mobile app downloads. So they're using branches for maybe relationship building and complex sales, and digital channels for scale, speed, and efficiency.
Okay, so moving beyond the physical footprint and the financial numbers, what's really driving this high level of operational efficiency? And maybe preparing them for the future. It sounds like it comes down to this digital-first NBFC DNA they talk about.
Yeah, technology is absolutely core here. And you can quantify this digital DNA pretty clearly. Get this, 97% of all their retail loan disbursements are now driven by scorecards or their business rule engine, the BRE. That means human error, subjective calls. They're largely taken out of the equation for most retail underwriting.
Wow, 97%. So nearly every retail loan decision is automated based on preset rules. How does that efficiency carry over to the collection side?
It creates consistency and, crucially, speed. Almost all collections, 99%, use digital channels now. Think about the operational leverage there. It removes huge amounts of manual work and speeds up getting the cash back in. They're clearly well beyond just basic digitization. They're actively using more advanced automation, especially Gen AI.
Right, they specifically mentioned Gen AI implementation. Where's that being focused?
They've outlined 6 key areas where they're putting Gen AI to work strategically. And these aren't just buzzwords. They sound like real operational tools. Things like using AI to help generate credit memos, allowing faster analysis and summary of complex files, and significantly boosting their ability to detect risks and anomalies. They're also rolling out multilingual virtual assistants. That means much better, faster customer service. It really seems like they're trying to embed an analytical advantage into every step of the lending process.
And if we connect this back to the bigger picture, these operations also seem tied into broader ESG, environmental, social, governance, and social responsibility efforts.
Yeah, the responsible finance angle is quite strong. On the environmental side, they have a big clean tech finance focus. They've financed over 500 projects, contributing to financing over 21 gigawatts of renewable energy capacity. That's a serious commitment.
And their social programs seem to go way beyond just finance, too.
They do. Initiatives like the Green Switch. That's about deploying solar, micro, off-grid systems, powering over 4,800 homes in areas without reliable electricity. Or Arogatara, which aims to eradicate curable blindness. They've screened over 1.3 million people, an incredible number. It really highlights that social contract the Tata Group is known for. And of course, we have to mention governance again. That strength is underlined by the AAA rating and a diverse board with a high number of independent directors, 5 out of 8 members.
Okay, so we've covered the strong core, the big integration challenge, the strategic pivots happening, and those deep digital roots. What does this all mean for the immediate future? What's the guidance for management?
Management has laid out some very clear and I'd say ambitious guidance for the rest of fiscal year 26, and this includes the consolidated picture, factoring in the motor finance cleanup.
Okay, let's start with the near term, FY26.
Right. For the full FY26 consolidated numbers, they're targeting AUM growth in the range of 18% to 20%. They're aiming for consolidated PE growth of 35%. And the really critical target, the one that basically signals the success of that integration effort, is getting the consolidated net NPA figure back down to less than 1.0% by the end of Q4 FY26.
Right, that net NPA target of under 1.0% by March 2026. That's the metric you should really watch above all others. It tells you if they successfully digested that TMFL portfolio.
Exactly. And then looking beyond just this year, the long-term 3-year consolidated guidance, it reflects really high confidence both in their core business and in getting that motor finance piece cleaned up successfully. They're targeting an AUM compound annual growth rate (CAGR) of 23% to 25%.
Wow, a 25% AUM CAGR target for a company this big that suggests they really believe their digital edge plus that AAA funding advantage is going to supercharge growth.
It certainly seems that way. They're also aiming for a PAT CAGR of over 30%. And underpinning this confidence are the return targets. They're looking for an ROA between 2.5% and 2.7% and an ROE between 17% and 18%. Now, to sustain those kinds of returns while absorbing the initial hit from TMFL, well, it demands flawless execution on that digital strategy we talked about. And crucially, their long-term targets for both credit cost and net NPA are both under 1.0%.
That's a very detailed roadmap indeed. So the key takeaway for you, our listener, is this. TCL is currently performing a pretty complex juggling act. They're keeping an exceptionally strong 22% organic growth engine running smoothly, while at the same time using their new AAA status and digital muscle to aggressively clean up and strategically redirect a major acquired portfolio. All this is aimed at setting themselves up for really benchmark returns over the next 3 years.
Yeah, we've definitely seen a clear pattern here. using structural advantages like that 60 basis point cost saving and the digital automation to fix legacy issues quickly. And this brings up an important question for you to analyze in their next set of results. We know the core business is chugging along at that 22% organic AUM growth. But to hit the high end of that 3-year AUM-SHE AGR target, that 25% number, the motor finance turnaround needs to kick in fast. So the thing to watch is, what proportion of motor finance disbursements in the next quarter shifts towards those used and multi-OEM vehicles? Tracking that specific mix shift, that'll give you the clearest micro signal on whether that 25% target is genuinely within reach.
That's excellent forward-looking analysis, a great point to end on. Thank you for joining us for this deep dive into Tata Capital Ltd. We'll catch you next time.